Welcome back, you legends. I'm Dr. Cal, and let's get right into this weekend stream. I missed you all, everybody, and it's been quite the wild trading week this past week. We've got a lot of ground to cover and a lot of things to discuss, talk about, analyze as we get into next week. In fact, let's start today's stream with next week's expected economic events. So starting Monday, we do have some consumer inflation expectations data coming out at 11 a.m. Eastern time. Tuesday, we'll have the PPI data. And then Wednesday, we'll have the big cajones, the CPI data, the inflationary data for the month of July coming out Wednesday morning, 1 hour before the market open at 8:30 a.m. Eastern time. Thursday, we'll have retail sales. And Friday, we'll have the Michigan Consumer Sentiment Index. So a lot of stuff coming up next week, a lot of market moving economic reports to discuss. Alrighty, let's take a look at the four main indices of the market. Friday closed in the green, but mostly flat, I would say. The Russell was down, even though the S&P, NASDAQ, and the Dow Jones moved higher. Friday, new highs versus new lows. We have more stocks making new lows versus new highs. Stocks trading above the 50-day simple moving average. More stocks trading below the 50-day versus above it. 200-day looking a little bit better. So it's a bit of a mixed look Friday. Not a big move. Most of the big moves happened early in the week, and then the market was mostly undecided Friday. We'll get into what that actually means once we get into the charts. Let's take a look at the stock market map for Friday. Market led by a broad market rally throughout Monday. After that Black Monday crash, we had Microsoft, Apple, Google, Amazon, Meta, and Eli Lilly leading the markets higher Friday. For the week, we have a mostly red market, right? We did not completely fully recover from the sell-off that happened over the weekend due to the Japanese market crash, that Japanese carry trade failing, leading to a lot of liquidations and that sharp sell-off that we had over the weekend. And then the market kind of slowly made its way higher throughout the rest of the week. Let's take a look at the different market sectors. Friday led by communication services, healthcare, and technology, both mostly a risk-on move in the market. Excuse me. Lagging were consumer defensives and energy. Again, excuse me, everybody. Mostly a risk-on move, meaning market participants continuing to buy the riskier assets, the riskier parts of the market, and rotating out of defensive sectors like utilities and consumer staples. For the week, market was actually mostly led by energy as the market begins to expect more rate cuts this year. This means a weaker dollar. A weaker dollar means more expensive oil, gold, and natural resources in general, any commodity basically, because all commodities are traded in US dollars. A weaker dollar means more expensive commodities. Rate cuts will lead to a weaker dollar naturally as the yield on bonds decline. Those holding short-term debt will want to begin liquidating those positions and looking at more attractive areas in the market. Now let's take a look at the daily chart for the S&P 500. This is the SPY ETF. We've been trading in this very clean uptrending channel. These vertical, very light blue lines are actually risk events. That means things like CPI reports or Fed meetings, right? So all of these I mark on the chart so I can reference them very quickly when I look at the chart. Again, next week we'll have CPI data on Wednesday, PPI data Tuesday, then consumer inflation expectations Monday, and we have the consumer sentiment coming up Friday. So we'll have a lot of market moving events. Usually that means a more volatile trading than usual. That means expect the VIX to spike again, probably next week in reaction to any negative report. The market is very vulnerable at this moment. That means any bad report will be read very negatively. The market will have a sharp negative reaction to that market report. Generally speaking, I do expect, or I do see that the market is actually bottoming. So I do expect a market bottom is in fact now forming. That means we'll have either a spike down next week to form a slightly higher low versus the low on last Friday, or a slightly lower low. Either one is fine with me. I do expect one final volatility spike to come in next week. We do have a lot of, again, catalysts to make that possible. We also had this very clean rally this week, or I should say slow melt up, right? Slowly making higher lows, each day making a higher low. However, as we approach this key level of resistance right around the mid 530s, we're now beginning to see somewhat of a hesitation by the market. Not that big of a move Friday because of that, because we have a lot of economic data coming up this week. And that largely means one major thing, in my opinion, a buying opportunity. That's why I do say that this will very likely be a very nasty bear trap. Bears that actually went short early in the week have consistently lost money pretty much every single day this past week. Those are trapped. That means any spike low in the market will be used by those bears that are trapped in short positions to exit those short positions. In my view, that means a higher low is more likely than a lower low coming up this week. Can we just continue to melt up? That's possible. I do think that's possible, although a much more plausible scenario for next week is, again, a dip back down. Dip gets bought. Johnny come lately bears that may short that sharp decline. It could happen in a single day. That means Tuesday we could see a sharp decline. Wednesday, Friday, it doesn't matter. We could see one day of sharp declines. The smart money that was trapped here shorting will exit on that sharp sell-off, that sudden spike that I expect in volatility and the VIX, leading to a sharp sell-off that will be used by trapped money to exit. And then the Johnny come lately bears, unfortunately, will try to short that spike down, and then they will get trapped. And after that point, I do believe we'll get a very vicious short squeeze and a move higher in the markets, continuing this trend of higher lows and higher highs. What other things are we looking at? Well, we have a stochastic for the S&P 500. It has already crossed over after entering oversold conditions. That means that momentum has now shifted in favor of the buyers over the sellers. This does not preclude any sell-offs or sharp liquidations or anything like that. What it does tell us that very likely whenever those sell-offs do come, they will form a higher low and that dip will be bought. It basically tells us that the trend is changing from lower highs and lower lows to higher lows and higher highs. That basically what this tells us. It doesn't really give us much more granular information than that. However, that is still very, very valuable. If you know that the trend is shifting from downtrend to an uptrend, that means you'll have to change your strategy. If you were shorting, you will now have to look at going long the market, buying those dips instead of shorting those rips. Now, big picture stuff, we're still in this very clean uptrend. I'm making higher highs and higher lows. We're still trading within this ascending channel. I do expect still more downside to come, probably in September and in October. Potentially something that looks potentially like this, either a higher high and then we move back down and make a higher low and then we continue higher. So a sharp sell-off coming up in September and in October, or potentially something that looks more bearish, something that looks like this, lower high versus the highs in July, then we move back down form either an equal low or a slightly lower low, and that will confirm the final bottom for the year, in my opinion, sometime in September or in October. Why is that the final bottom? Well, because seasonality for election years dictate that we do get a negative September and October. That pre-election volatility, we're already starting to see that with this massive spike in volatility leading to this correction that lasted now for 4 weeks. That correction is now ending, and I do now expect to see a move back higher that should last between 2 to 3 weeks until the end of the month, and then potentially that inflection point back down in early September after the Fed meeting and the rate cut. Generally speaking, the first rate cut is viewed negatively. That's generally because the Fed is historically speaking is usually late. That means they don't cut until after the economy has already deteriorated. We're already seeing evidence of this, obviously, because the Fed has continued to maintain rates even as the jobs market has been screaming recession is coming after the unemployment ticked much higher than expected a couple of weeks ago, leading to this huge gap down and sell-off in the market on Friday, August the 2nd. So this is big picture stuff. Local bottom forming that should hold for about a couple of weeks. Potential spike down next week. Higher low or equal low. A dip that should be bought. We then move on back to make higher lows and higher highs into the end of August. And then we either form a higher high that should mean that we should form another higher low on that sell-off in September or October. Alternatively, we make or form a lower high that tells me that we will likely move back down to form a lower low in September or in October. So that's the big picture stuff for the S&P 500. Looking back at the NASDAQ, this is the QQQ ETF, the NASDAQ 100 ETF. We've been trading perfectly inside this ascending channel since the bear market of 2022 ended, right here through this complex bottoming structure. Final low was put in January for the NASDAQ. It was put in October for the S&P 500. The NASDAQ then went on to make higher lows and higher highs consistently. Now, there is a big development in the NASDAQ 100, and that is we actually broke this support trend line for the first time during this Black Monday sell-off last Monday. That's unfortunate. This means that we will likely now not be able to rely as much on this channel anymore. But again, I'm still expecting pretty much the same thing here. Double dip, something that looks like this. Second dip gets bought. Higher highs after that, with the rally continuing until the end of the month, with the NASDAQ very likely forming a lower high rather than a higher high. And then we move back down, form either a higher low or a lower low to put in the final low for the year. And then we get that post-election rally in November, December. And then my expectation is that next year, 2025, that's when the next cycle of the bear market likely begins if we enter a pretty bad recession, which after such a prolonged period of rate hikes, maintaining rates high for so long, the yield curve being inverted for so long, and that very deep inversion usually means that the recession on the other side of the coin is usually pretty bad. The longer the yield curve remains inverted, the deeper the inversion usually leads to a deeper and sharper, longer as well, recession. Let's take a look at the Dow Jones. Now, the Dow Jones actually formed this nasty double top, slightly lower high on this second top. This is, by the way, the S&P 500 in blue and black. The green and red is the Dow Jones Industrials. Now, we had this double top rejected to make a higher high as the market formed this bearish engulfing candle. As soon as I saw this candle form, I actually sold. I had been holding Microsoft leap calls. I sold those for a profit, and I managed to save myself from a lot of pain. However, I have to admit that I did enter back into the market, Friday. So I had to go through that Black Monday sell-off. shockingly, surprisingly, because the VIX spiked so high, volatility, the implied volatility went up so much that I was holding leaps, NASDAQ 100 leaps. I bought them Friday. I sold them Monday because I saw that huge volatility spike. I actually managed to get out of those leap calls with a minimal loss. In fact, the price at which I sold uh, uh, those leaps have actually not recovered those prices since I sold my leaps 5. They were the June 2025 NASDAQ 100 triple Q calls. I sold them for 19.9. The NASDAQ actually went back to fill the gap from prior Friday. But because volatility was so insane Monday, it was so bad Monday. When I went ahead and sold that position, the loss was so tiny because that huge implied volatility meant that the call option retained a lot of extrinsic value, a lot of its extrinsic value was retained. So I sold it for a minimal loss. And then even after the market recovered for several days after, the price for those calls never went back to 19.9. So I sold them for 19.9 right after the market opened because I saw that how much of a value they retained, and I got on. And those calls continued to decline even as the market moved higher because of that implied volatility, because the VIX had spiked so high and then gotten crushed. Right, this is the VIX chart for the market. This is the volatility index for the S&P 500. Below that is the S&P 500. I saw this insane spike in the VIX, and I saw how much value those calls retained, so I decided to sell. And even though the VIX moved down and the market moved higher the following consecutively, in fact, higher lows every day for the rest of the week, those calls never went back to 19.9. A lesson in implied volatility. Kind of funny because if I had actually been holding NASDAQ, the triple Q ETF in shares, or maybe a margin, or if I actually been holding levered ETFs, I would have lost way more money than if I had actually just held those leaps. Now, after I sold those NASDAQ 100 calls, I did go back into the market. I actually went back into Nvidia after this spike down in the market. I went back into Nvidia at the open on Thursday, and I've already recovered all of this loss from selling on Monday. Recovered entirely, even though Nvidia has barely moved Friday. Really, it was flattened down, but still managed to make all of that back. So I guess the lesson here is, if you see a huge spike in volatility, it's better to be a seller of options than a buyer. That's exactly what I decided to do. Even though it was a big move down, I decided to sell. That was honestly a very lucky move on my part, because the VIX had spiked so much. Had this been a move down, a slow move down without a huge spike in the VIX, the loss would have been much greater due to the implied volatility. Right, so we covered the NASDAQ 100. Again, another spike down, higher low, very likely, perhaps tagging this 200-day moving average. Then we move back up to fill this key gap at 459 for the NASDAQ, and it's this key gap at 543 for the S&P 500. Very likely that happens sometime next week. So maybe something that looks like this, in my opinion, is very likely. Dow Jones, again, we said there was this double top and it rejected. It moved back down as the market formed this bearish engulfing candle and moved lower. Now the market is starting to look a little bit like it is forming this bearish ascending wedge. Very likely will break, give us that second flush down, that second spike. That will, in my opinion, be a bear trap, because any bears shorting on that move down will be trapped again, because I don't expect the market will continue this correction. This correction is ending, and I have a lot of evidence to suggest that's the case. That I will go through in this video, so please make sure to stick around. Subscribe if you haven't yet. So let's take a look at the S&P 500 1 hour chart. These were the daily expected moves based on what the options market was pricing in. I highlight these in the Discord community. During periods of heightened volatility, the market actually ended up closing pretty much smack in the middle of this expected move. Did not tag the upper level, did not tag the lower level, continued to trade above this near-term moving average, this a green stair-step moving average on the hourly chart. That is positive. We've now recovered above this medium-term moving average, the blue moving average. That's also positive, all indicating that the trend is changing. Again, consecutive higher lows on the market, consecutive higher highs. Even though I'm expecting that spike down, I do expect that to make higher low and then for the market to continue higher. Now, in terms of key levels of demand and supply, we do have 530. This is a prior key level of resistance, rejected once, twice, 3 times, 4 times. And then we had the market breakdown in May. Then it held, recovered, and went back up. Again, the market tried to consolidate right around this key level of 530, and then we had that breakdown Monday. Then we had, again, look at this, another key reaction to this level 530, rejected once, came back down, formed a higher low, then continued higher. This tells me that 530 is a major pivot level. That means whenever we're trading below it, it is resistance. Whenever we're trading above it, it is support. We're not trading above it, it should act as support. That means whenever we do get that spike down, expect the market to spike down quickly, then recover perhaps the same day or the next day back to 530. That is kind of what I'm expecting next week. I'll go over the expected moves for the week in the Discord community. I post them basically in the weekend every week for the upcoming week. So the expected moves for next week, I'll be posting in the Discord right after this live stream is over. Now, 530 is support for now. 538 is the next level of resistance. Why? Well, we had developed this market structure, this range, equal lows. Look at this, consecutive equal lows, consecutive equal highs, one false breakout, went back down to the bottom of the range. This tells me that it is now another key pivot level. So 538 is another key level. So one way this could play out is we rally early next week back to 538, reject, then move down all the way down to make that, to form that higher low. A key level of support to watch could be this gap right here. This gap could be in play now. This is a key gap. The gap itself could act as support, or we could fill the gap. Either one is valid in my view. So this means this range right here. This range is now support, right? This range is now key support between 518 and 523. So let's call it 520. 520 is now support. Let's annotate this on the chart. 520 is support. This is where I would expect the a higher low to form. So let's go back to our there we go. Let's go back. So something that looks like this, spike back down 520, form that higher low, right? Higher low, and then move back up and clear this 538 level for the time. Okay. So this is for the SPY 1 hour chart. One other key development or reaction that I should point out is this. Now pay very close attention to the stochastic. This is the stochastic. I have very specific proprietary settings that I use in the stochastic for the stochastic that you'll find in the Discord community. So generally speaking, how we use the stochastic in the 1 hour chart is whenever we get a bearish cross in overbought conditions, that means we get a sell-off. Whenever we get a bullish cross in oversold conditions, overbought and oversold. So oversold conditions, we get a bullish cross. That means we move up. A bearish cross in overbought conditions means we move down. That's basically how we use it in general. There are some very peculiar reactions. For example, in here we had this crossover before we entered oversold conditions. This often means that we get a very impulsive move higher, right? Again, look at this bullish cross before we entered oversold conditions. We had an impulsive move higher. That's basically what it means. It also indicates that bears are losing or sellers are losing momentum. Buyers are in control because sellers or bears, shorts had the momentum. The bearish cross had already developed, but they could not move the market much lower. It recovered very quickly and moved back up. That's basically what it means. It means sellers failed to take back momentum, and as a result, we had that continued move higher. We're back now in overbought conditions. We haven't crossed down yet. It is possible that we could do that as soon as Monday. As soon as Monday, we either open higher, then continue to this key level of resistance, 538, then move back down, fill the gap, and then continue lower the following days. Another possible setup how this could play, we could move slowly up, maybe take a couple of days, then reject, and then get that liquidation, very quick sell-off over perhaps one trading sessions, and that's it. We get that final bottom, and then we move back up. Okay, so this is for the S&P 500 1-hour chart. Let's take a look at the NASDAQ 100 1-hour chart. This is a much cleaner chart. Why? Well, we do have this very clean resistance line, rejected here, again. So this is now a magnet. This is a level of very clear resistance. This is where I would expect this rally to stall. It also happens to be the bottom of this range. Just like the S&P 500, the NASDAQ developed this very clean range. Once we broke above it, we continued all the way to the upper edge of this resistance level, rejected, moved down all the way back to the bottom of the range. So this is a very key range, and this level of support at 455, 456, somewhere around there. By the way, this is the daily expected move. Let's change that now to 456. Let's call it 456 for the NASDAQ. That will now act as resistance. Again, I'm expecting somewhat of a similar development here. Rally back to the resistance level, bottom of this prior range, potential rejection here, move back down, find support at a higher low, and then continue the rally from that point forward. For the NASDAQ 100, the key levels of support at 443. This was a very clear pivot point. Look at this. A lot of trading took place at this level. Was resistance, then we broke through it very quickly. Then we came back to back tested. It acted as support. And once again, we gapped down below it, moved all the way back to this level. So it's a magnet. Whenever you're below it, the market will try to move back to it. Whenever you're above it, the market will find support and will find buyers at this level. We'll take a very quick look at the questions. I'll try to answer them as best as I can, and then we'll go back to our presentation here. Kelvin Lim, great to see you posting videos again. Thank you so much, Kelvin. AJ, great analysis. Thank you, AJ. Marion, don't you expect some type of crash after they cut rates in September? I do expect the second wave of the correction to come in September and in October due to seasonality. This is election year seasonality, specifically for election years. Last year was a pre-election year. We had a different kind of seasonality chart. So in election years, we do have open field elections. That means we don't have a sitting president running. That's basically what we have this year. This year, election year seasonality, where we have an open field that usually leads to a greater bout of volatility in September and in October. It is so bad, in fact, that the November and December rallies tend to be very muted, right? All election years is in black, right? This is what it looks like in November, December, very positive. Sitting president running is the most positive. That's kind of how we treat it throughout this year until President Biden dropped out of the presidential race just a couple of weeks ago. What else do we have here? Yeah, so let's go through what actually happens in election years in terms of seasonality. Usually what happens is we get this summer rally, spring to summer rally. That means April, May, June, July, August, all tend to be positive. Generally speaking, we do have some pullbacks in May. We kind of got that in April, right? It happened earlier this year. We had that pullback in April. Here's the pullback that I'm talking about. Here it is. This minor correction happened in April. That's why May was a positive month. That sometimes happens with seasonality, everybody. Sometimes seasonality gets pushed forward a month or pushed back a month. It's okay. It doesn't really affect how we look at the markets. So we get that summer rally all the way into August. August tends to be the last positive month in this huge multi-month run-up. Then we get a negative September, negative October. So we're now in that August kind of time frame. We did get that huge spike in volatility in August that potentially could be seen as September volatility getting pulled forward into August. That's possibly the case. That means the October volatility could be again moved forward into September, and in October we actually form a higher low instead of a lower low. So this year's seasonality could actually look something like this, right? So we had a sharp decline in August, then we move back up in September, another dip in September, then potentially we get a positive October, right? That could possibly be the case. Another way to look at it is we could get a first wave in August. I think that wave is done. We rally into the end of the month, get another wave down sometime in mid-September into mid-October, form a lower low in October, and then we move back up, right? That could also look something like this. Either case is fine. One key indicator to watch or development to watch again is the S&P 500, whether we make a higher high, versus the high in July, or whether we actually make a lower high. If we make a lower high, if we form a lower high, likely we also form a lower low. So that's what I'm going to be focused on at the end of the month into September, as well as how the market reacts to the first rate cut in September. One way to look at it is will the market react negatively to that rate cut in September if the Fed only cuts by 25 basis points? That's because rate cut expectations have actually shot through the roof after Black Monday. The expectation for the year was 2 to 3 rate cuts, so about 75 basis points of cuts. Now the expectation is almost double that at 1.25%. That means the market is actually expecting the Fed potentially to cut by 0.5 percentage point in September, again in the next meeting, and 0.25% after that. That means if the Fed only cuts by 25 basis points in September, the market could view that as negative, and the market would actually sell off in September because of that change in expectation. That's one way to actually look at it. So again, key reaction to the Fed decision in September is going to be key. Whether the S&P 500 makes an equal high, higher high, or lower high, another key into gauging what happens in October in that second wave of the sell-off. So that's for election years. Now I do have a 4-year seasonal chart. Take a screenshot of this if you want to have it handy with you. It looks pretty similar to what happened this year. We tend to get this 2 to 3 month sell-off, September, October into early November, then a big rally after the election, usually in early November. That means November 8th. After the election, that's usually when the market starts to move much higher. So that's that's pretty much a pretty long answer to that question about do I expect a crash in September after the rate cut? The answer is not necessarily a crash, but yes, another wave down, very likely. So guys, last couple of questions are about SMH, so semiconductors, and indeed NVIDIA. I'll cover these at the end of the stream. I'll go over all the tickers. I don't see any other questions, so let's keep going here. Let's go back to our presentation. And now let's move over to the futures. So the two charts that I watch for near-term moves are the S&P 500 and NASDAQ hourly charts and the futures charts. Now, because the futures trade in all 24 hours of the day for most days except the weekends, that means that 4-hour candles for the futures are pretty much roughly equivalent to 1-hour candles in the hourly chart for the ETF, so the SPY and the NASDAQ. That's why I use the 4-hour time frame for the futures. If you've been wondering about that, that's why I use the 4-hour time frame for the futures. It's basically because of that reason. It gives me an equal number of candles to the S&P 500 hourly chart. Okay, so what do we have here in terms of market structure for the futures? Again, look at this perfect range, tagged the bottom twice. We had that false breakout, rejected, moved all the way back down to the bottom of the range, and then we had that precipitous sell-off in the after-hour session between Thursday and Friday. Then again, before the market opened this past Monday. That's basically what happens. Now, one of the very key things that I always talk about with new traders, if you want to understand the market, the number one thing I always encourage everybody to start with, if you're trying to learn technical analysis, is number one. You want to study candlestick structures. That's number one. Okay, candlestick analysis. That's the number one thing to learn. If you're a new trader, that's the number one thing. Okay, number two, right after candlestick analysis, is market structure analysis. So what's the difference between candlestick analysis and market structure analysis? Basically, candlestick analysis amounts to 1, 2, or 3 candles. That's it, right? So a candlestick structure is basically made up of 1, 2, or 3 candles. That's it. Market structure analysis is made up of way more than that. And I'll give you a very direct example, okay? So candlestick analysis, if I look at this candlestick structure, 1 candle, 2, 3, what does this candle structure look like? Please post in the comments if you know what this structure looks like. To me, it looks like a morning star pattern. What is a morning star pattern? Well, you get a move, you get a red candle down, okay? Then you get a smaller candle that could be either red or green. So let's go with blue. It doesn't matter, either red or green. Then you get a green candle back up, right? And this green candle could close way higher. It could close lower. It doesn't matter, okay? So these 3 candles, the psychology behind these 3 candles, yes, green. So the psychology behind these 3 candles is sell-off, very negative sentiment, very bearish, and all of this negative sentiment culminates in the end of that negative sentiment in this smaller candle. So lots and lots of selling. Then that selling slows down, and then that selling ends. That a negative sentiment switches to positive, and you get this rally. So so you see that the psychology on the chart, directly on the chart, it's not hocus pocus, it's not reading tea leaves, it's direct market psychology. You see exactly what traders feel like and what they think based on the kind of candle that forms. very negative, very bearish, fearful. Then that fear begins to subside. The candle gets smaller, right? The fear subsides. In this example, we actually formed an equal low, right? So the selling ended, the sentiment begins to change. Then we get the confirmation, that green candle, and then we get consecutive green candles. So that's candlestick analysis. Basically, this is one example. It's a morning star reversal. Another example is evening star reversal. It's the exact opposite, and you see it directly right here. Look at this. How perfect is this? Green candle, red candle rejection. Then you see the sentiment switching to bearish and negative, and then we move back down. And when these reversals happen at levels of interest, they are way more powerful, way more meaningful. And this is a level of interest. Why? Well, we have two key moving averages and it rejected at both. This is a key level of interest. Why? Because it was the equal low to this prior low. It gave us a range. So it's not arbitrary. You don't look anywhere in the chart and say, oh, look, we have a morning star reversal here. Not really, because there's no follow through, right? No green candles, very tiny, small, right? They're meaningless. And even if I go back all the way here, look at this rejection, huge move down, then kind of sideways, not much happening. Then another rejection, but rejecting the sell side activity. So the candle wick or the candle tail is down. That means all that price action to the downside was rejected and we moved back up. That's basically what it means. And then again, it happened here. This was a liquidation grab right here. It broke below these prior lows, grabbed the liquidity it needed, tagged the support level, then moved back up. Right? So you can apply this on any market structure, any time frame, but the bigger the time frame, the more meaningful these candlestick structures or candlestick analysis is. Now, what is a market structure? Market structure is more complicated. It's when we look at things like ranges, right? Double bottom, double top. This is a clear range. This is made up of many candles. Again, another range here. Double bottom, 1, 2, second. A low is a higher low. That's bullish. Then we get this consolidation, right? Move sideways at the upper edge of this range. This tells me that the market is now just waiting, building up momentum to make that move higher, right? Another interesting way to look at market structure is this breakdown. Look at this breakdown, right? What does this tell us? Well, we don't have a lot of trading here. We have a lot of candles here. So many candles here, not many here. What is that? What am I actually saying here exactly? Well, we traded in this range for many days. Again, traded in this range for many days. This breakdown happened in a single day. This gives us what is called an air pocket, an area where we don't have a lot of trading, right? Not a lot of trading happening here. And as a result, moves in this air pocket will be very quickly, right? Boom, we'll move right through this level. We're now building momentum. This tells me that this entire area will be covered in a single day, right? One single day and the market will cover this entire area. That means a rally all the way back up to this prior level of demand, this area of the double bottom that I covered on the hourly chart for the S&P 500, 538, that's key level. That means the rally from current levels to 538 will happen very quickly over probably one trading session. That's basically what this tells us. When you see air pockets like this, price likes to move very quickly in an air pocket. So that's basically the kind of structure we have. Downtrend, right? Lower highs, lower lows. We got our first higher low here. We're now consolidating at the upper edge of the this range. That means whenever we break out, likely it's going to be quick. Move back up to the neckline, 5,440. So that's equivalent to the level on the SPY at 538. That's for the futures. it's 5,440. Okay, so on the futures chart, what we're looking for next week is going to be that quick move up, reject, move back down, find support either at the bottom of this range, right, or at the middle of the range, doesn't matter. Move quickly to the upside, get that spike back down, that final flush, that final liquidation, get rid of all of those weak hands, allow the trapped bears that shorted the market Monday to exit with a smaller loss, put in that higher low, and then move back up, right? So that's kind of what I'm expecting. Same thing for the NASDAQ 100. In terms of momentum, the RSI is smack down in the middle. However, the stochastic is getting slightly overbought here. Again, that goes in line with my expectation of a quick spike higher, then move back down, get a higher low, and then begin that process of forming higher lows and higher highs and complete that bottoming process that began last Monday. So what does that look like on the VIX? The VIX is up top. The volatility index below that is the S&P 500 futures chart, right? So we had that bottom, higher low on Thursday, and then we moved higher, slightly higher on Friday. The expectation now is something that looks like this, right? One final rally, either Monday, Tuesday, something like that, then move back down, form that final low, and then continue higher. Is it possible for the market to continue to move higher without that spike down? It's possible, but it's not likely. And I'll show you exactly why that's the case. Let me pull up the my original chart. Yes, this is the original chart for the VIX. So VIX up top, S&P 500 down below. We had that huge, massive spike in the VIX. By the way, guys, this is very important. So please, if you've been kind of glossing over the stream, please just try to really focus on this part, because it's going to help you a lot in calling bottoms. Okay, so VIX up top, S&P 500 futures down below. We had that huge spike higher. Usually markets will bottom when the VIX spikes higher, comes back down, gets the second spike, and moves down. Usually that second spike will form a lower high in the VIX that will correspond with the final bottom in the market. That's usually the case, not always the case, but often is the case. Okay, so that's kind of what I'm looking at, or what I'm looking for, number one. Number two, another key development to watch for the VIX. The daily chart for the VIX, you want to watch the 10-day moving average. So where's the 10-day moving average? It's this moving average right here. The light blue, light green moving average that switches from light blue to orange, okay? Why is it important? Well, whenever the VIX is trading above it, it means the VIX is trending up. And when the VIX is trending up, the market is trending down, because they are inversely correlated. When fears are rising, the market will be moving down. People will be selling. Okay, that's number one. Number two, whenever we close below the 10-day moving average, it very often confirms the bottom, the end of the uptrend for the VIX and the beginning of the downtrend. Okay, what we usually need is 2 consecutive closures below the 10-day moving average, right? So if we continue to move down, that's usually it. It calls the end of the uptrend in the VIX. That means the VIX is not likely to make a high that's higher than this one in quite a long while. Okay, that's basically what it means. It basically means that if the market moves down, it will be a higher low. It will be a dip that gets bought. It will be a continuation of an uptrend that is now beginning, because the uptrend in the VIX is now ending. That means the uptrend in the S&P is now beginning, and the downtrend, the correction in the S&P, is ending. Again, one key thing is huge spike in the VIX usually is followed by another spike, lower high. It confirms the bottom in the S&P. That's number one. Number two, close below the 10-day moving average. You want to see 2 consecutive daily closures below the 10-day moving average. That usually confirms the bottom for the S&P and the top for the VIX. That does not mean we don't get any sell-offs. That does not mean we don't get any dips. What it means is that when the dips happen, they will be bought and we will likely to form a higher low. That's basically what it means. So what evidence do I have to say any of this stuff? Okay, so let's go through some of these exact signals that I talked about just now. Okay, so let's go back to the correction back in April. We had that spike in the VIX, right? So we had this first spike, second spike formed a slightly higher high on an intraday basis. However, on a closing basis, take a look at this. Where is it? There you go, step line. So on a closing basis, so this is volatility. On a closing basis, look at this. Volatility formed a lower high, right? The second high is a lower high and on a closing basis. And what did that lower high correspond with? Let's drop a vertical line. Boom, it called the bottom exactly to the day, right? Called the bottom exactly to the day. That's kind of what I'm looking for now. That's kind of what I want to see now. Second spike in the VIX, lower high calls the bottom. So that's number one. Now let's go back to the candlestick structure to look at where the VIX closed right after the market bottom. Look at this. It closed below the 10-day moving average. If it closes once, it doesn't mean anything. We need two consecutive daily closures, then it did it again. That confirms the bottom, right? So the two key signals that I talked about, double spike, double top in the VIX, and the daily closure below the 10-day moving average, both happened. It called the bottom. Let's go back to other key bottoms. Let's take a look at the. In fact, let's take a look at the 2020 COVID crash. Why not, right? Why not? Let's take a look at it. Do these two rules apply? And let's see, right? Let's see. Okay. So VIX up top, S&P 500 down below. Let's look at when did the VIX complete two consecutive daily closures below the 10-day moving average. This was the first day. This was the second day. And what do you know? Hallelujah, it called the bottom exactly to the day. Kind of funny, right? It's kind of that amazing signal to watch. Called the bottom exactly to the day, right? The market bottom exactly on that second consecutive daily closure below the 10-day moving average, right? What about the VIX? Did the VIX get that double spike in this case? Well, it did, and I'll show you what I mean, right? So the VIX stopped right here. This was the VIX stop, right? That was it. The VIX stopped here. Did the market bottom on the VIX, the final high in the VIX? No. The market continued to move lower for several days. So this was the top in the VIX. The market moved lower the day after, and then bottomed on the third day. 3 days after the VIX put in the top. Did the VIX get a double top second spike? Yes. Well, it moved down. Then it had that second spike. This is the second spike. And that second spike got reversed the same day. So we got the close below the 10-day moving average. The market spiked back up. And had the market closed, or had the VIX closed above the 10-day moving average here, that would have told us that the downtrend in the market is still ongoing. It did not end. The uptrend in the VIX is still ongoing. It did not end. That's why the second spike had to be cut short, because the market had to close. It absolutely had to close below the 10-day moving average. The VIX that day had to close below the 10-day moving average for the market to confirm a bottom and the end of the downtrend in the S&P. That's why the second spike was cut short, because the market had to close below the 10-day moving average. I should say, not that the market, the VIX had to close below the 10-day moving average on that day. That's why the second spike was cut short. That's basically why market participants looking at this had to close it below the 10-day moving average to confirm a bottom and the end of the downtrend in the S&P, the end of the uptrend in the VIX. And that's basically it, right? Had they not closed it below the 10-day moving average, had we got another spike, that means the market would have moved lower still. This downtrend would have continued still. So they had no choice. If they wanted the market to bottom that day, they had to close it below the 10-day moving average. And it's the big money that decides. It really is. That's honestly how it is. The big money decides that, yes, we want to bottom this day. We'll close the VIX below the 10-day, and that's it. Right? The big money decides, and the big money decided, yes, we want the market to bottom Monday, 23rd of March 2020, and it did. So let's take a look at a bunch of other market sell-offs, corrections. Let's look at this sell-off at the end of 2018. This was the trade war with China, tariffs from the US, tariffs from China, each putting on new tariffs. The market was terrified that that would paralyze trade between the two nations. And we had that precipitous sell-off in the market and the spike in the VIX. Now, in this example, again, closed below the 10-day, second consecutive close below the 10-day. It confirmed the bottom. The market went back, had this very tiny dip, second dip, and then moved higher. In this case, the VIX did not get a second spike. It did not happen. The market simply continued its slow melt up higher. This could happen next week. It is very plausible. However, it's not likely. Usually these bottoms develop when some huge fundamental change happens. That means this entire sell-off happened because of the trade war. As soon as that trade war ended, as soon as we heard news from China and the US that they wanted to end the tariffs, no new tariffs coming, the market bottomed immediately, right? So there was no need for a second spike higher for the VIX because the fundamental driver for the sell-off ended. That was it. There was no need for that technical second spike, right? Now let's take a look at a couple of other examples. Now this one is a perfect example of both of the technical signals that I discussed, right? First spike in the VIX, second spike corresponded perfectly with the market bottom. Lower high for the VIX, higher low for the S&P, very slightly higher low versus this prior low. The fact that the VIX formed a lower high, that confirms the bottom. We went on to close 2 consecutive days below the 10-day moving average. Bottom confirmed. We went on to move higher. Okay. I hope that makes sense. Before I move on from the VIX, I'm kind of giving you guys golden nuggets. Nobody will teach you anything about this stuff, right? I've never seen anybody use the VIX the same way I've been using it. A lot of people will actually say, a lot of traders will tell you technical analysis for the VIX is a waste of time. Technicals don't apply to the VIX, blah, blah, blah. They're not looking at the right stuff. You have to look at the right stuff. We don't look at bull flags. We don't look at stuff like that for the VIX. That's true. We don't look at all of these technical structures. We just look at double bottoms, double tops. Okay, so double tops for the VIX, double bottoms for the VIX. Those are important. And the 10-day moving average rule. If anybody has any questions about the VIX, please post in the chat, and we'll move forward after I've answered any questions you guys. So Cole asks, how do you feel about Chinese stocks like Baba, JD, Baidu at these levels? I'll cover specific tickers at the end of the stream, so please remind me. Again, Coinbase. Again, guys, I'll cover specific tickers at the end of the stream. Right now, I'm just going through big picture stuff, right? So the market bottoming, traps coming up, key levels of support and resistance, stuff like that. I'll cover the tickers at the end of the video. Jin Kim says this guy is a newbie. Well, thank you, Kim, for sticking around to watch a newbie stream. That's very generous of you. Bank of Japan announcement. equals no second spike? Possibly, yes. I agree with you. I think that's very possible. However, so this is a very smart question. So because the Bank of Japan announced that they will not go on with rate hikes as long as markets are volatile and unstable, does that mean we don't get a second spike in the VIX? Now, to answer that question, we basically need to answer the question of the Japanese carry trade. Let's take a look at the futures chart for the Japanese index. Okay, so basically what you're trying to figure out is whether the Japanese carry trade, that contagion that happened, folks borrowing from Japan because the interest rates are so low, taking those funds, converting that money, that currency from yen, Japanese yen, into US dollars, taking those US dollars and buying US stocks. So that's the carry trade. You borrow from Japan because the interests are so low, the interest rates are so low. You convert the yen into US dollars and you buy stocks in the US, okay? Or anywhere else, it doesn't matter. That's the Japanese carry trade. So what's the risk for the Japanese carry trade? It's interest rate hikes by the Japanese, by the Central Bank of Japan, okay, by the Bank of Japan. And the unthinkable happened. Everybody thought that Japanese central banks or the Japanese central bank will never hike rates because the entire economy of Japan depends on currency controls, very low interest rates for Japanese bonds, etc., etc. So nobody expected a rate hike from the Bank of Japan. And when it happened, we had this precipitous sell-off because everybody that had converted those that currency, the Japanese yen, to US dollars, as soon as the Bank of Japan hiked rates, the yen grew stronger. It gained value against the US dollar. That meant instant losses for all of those FX trades that had to mean liquidating positions and assets in US markets or any other markets for those traders, getting back US dollars, converting those back to yen to pay back the lenders, right? So that's basically what happened. So the question is now, is the risk from the Japanese carry trade over, right? Is the contagion over? The only way the VIX does not get that second spike is if, in fact, the Japanese carry trade, that risk associated with the Japanese carry trade is over. The liquidations are over. If that risk event is done and behind us, then yes, I would agree with you. Honestly, there's no way to know for sure if that's the case. We could easily get a second round of liquidations, right? And a second move, very sharp move lower for the Japanese index. And that will absolutely lead to a second spike in the VIX and will give us that second spike. So we can't know for sure. The fact that the Bank of Japan said we will not hike rates as long as markets are unstable, that's positive, right? But that in and of itself is not enough to completely write this risk off. Grandizer asked why you stopped uploading consistently. I actually talked about that in the first stream I did earlier in the week. I had done a stream. I've taken it down since. After the stream goes up, the prior one will go down. I do this, right? I don't keep the streams up because there's a lot of dead air in the stream, right? A lot of downtime in the stream. It's not a great YouTube video, quote unquote. And I did not have time to edit them. So basically why I've been absent is it's pretty easy to answer, right? It's pretty easy to answer. The last time I posted a YouTube video was here. I said that the market actually bottomed and we're going to get a massive rally. A lot of people were looking at this double top and saying that the market was going to move back down. This correction is going to continue. In my last video, I said that's very unlikely to happen now. We have very likely bottomed and we're going to get a monster rally. That's exactly what happened. Then I wanted to actually upload here in early April, but I was actually planning for my honeymoon and some celebrations and stuff. So throughout this period, I was actually away on my honeymoon. That's why I did not upload. So I don't really like to upload when nothing is happening in the market. It's an uptrend. Do I come on every day and say, oh, it's an uptrend, just buy the dip, just buy it? It's boring, right? It's an easy market. You don't really need me, honestly. But when things start to get really tough, that's when I usually want to come back on here and post more videos, because I think periods are like this are very challenging. A lot of traders looking for technical analysis, high quality technical analysis, will really benefit from these videos. But in a very easy market, it's really honestly kind of pointless to keep uploading videos saying the same thing over and over again. With that being said, throughout this time, I was posting every single day in the Discord community, both a big picture S&P 500 analysis, as well as picking stocks. So during periods like this, right, easy market periods, uptrends where you just buy the dip consistently, this is the best time to be a stock picker, to try and pick the best performing stocks to try and beat the index. That's what I've been doing in the Discord community. By the way, you can join it. If you Google Money Time Machine on Patreon, you will find it. And I do not share specific stock analysis outside of Discord. It's how I give back to the amazing legends that have supported me for so long. So I try and keep those specific ticker analysis, for individual stocks in the Discord community. I've done some of that at the end of the streams, and that's about it. But all of that stuff, picking stocks, giving specific technical analysis on specific names, I do that in the Discord community. I just don't do that on YouTube. So if that's kind of something you're interested in, check out the Discord community. Alrighty. The SPY is linked with Bitcoin in many times, says AJ Chintu. I'd say Bitcoin is closely correlated with the growth sector of the market. That tends to be the NASDAQ 100, as well as small cap growth stocks. So I would say something like, I think it's ticker VOO. Not indices, ETFs. Vanguard. No, it's yes, it's BUG. That's right. So it's the Vanguard Growth ETF. So I'd say Bitcoin is closely correlated with the tech sector and the growthy parts of the market, not value. So I would consider Dow Jones value and the NASDAQ growth. So I'd say Bitcoin is correlated with growth more than it is S&P 500. Folks are asking about Coinbase again. I'll cover Coinbase at the end of the stream. If you stick around to the end, I'll cover all of the tickers that you'd like me to cover. How are yields performing, and causes crash and rate cut? Wise guy 260. I'm not sure what you are referring to. What do you mean causes crash and rate cut? Do you mean rate cuts usually cause crashes? That's not the case. The rate cut itself does not cause the crash, right? Rate cuts are positive for the market. It's the case that usually the case that the Fed is too late, right? They cut rates too late, that the health of the economy deteriorates enough for the Fed to cut rates. That's why rate cuts are usually associated with bad market outcomes because the Fed does not do them until the economy has already deteriorated. The crash comes from the economic deterioration, not from the rate cut itself. Hope that makes sense. Right, I think I covered all of the questions. We'll take a very quick break here, just a couple of minutes of a break here, so I can grab a drink, and we'll come back and finish. Okay, guys, thank you so much for sticking around, and we'll be back. I have a lot more to cover, by the way, guys. So much more. I think I have at least another hour and a half before we're done here. So quick break, and I'll be back. Jacob, I did not ignore your question. I saw your question. You said, can you chart a Coinbase? I said, I'll do that at the end of the stream. Don't worry, I'll do it. I saw the question. I will answer it at the end of the stream. Thanks for sticking around, everybody. We're halfway through, if you can believe it. This is how long it takes me to get these videos done, by the way. I record them over 2 hours, maybe a couple of hours, edit them, trim them down to as short of a video as possible. The editing takes me twice as long, so if the video is 2 hours long, the editing takes me at least 4 hours, usually 6, and then I upload the video. So it takes 5, 6, 7 hours to get a video out. Some of you have been asking me, why haven't you uploaded in a while? Time constraints has a lot to do with it. Okay, so we covered the S&P, the NASDAQ 100, daily, hourly, and futures charts, overall macro outlook, seasonality for election years. We have also talked about the VIX, market structure for the VIX around market bottoms, right? And we also discussed economic events coming up next week. And now we're going to move over to cover other technical indicators that are amazing at calling reversals in both tops and bottoms. So let's start with the ratio chart between the NASDAQ 100 and the S&P 500. So the way to look at this chart is we take the NASDAQ 100, right? Triple Qs. Then we divide the triple Qs by the SPY, the S&P 500. That's how you get this chart, right? That gives you this this chart up top. Then I click plus, and I layer on top of that the chart for the NASDAQ itself and the chart for the S&P 500 itself, right? So this is the ratio chart up top. It really summarizes the performance of the NASDAQ 100 relative to the S&P 500, and it's very important to track this relative performance. I'll go through that in a second here. Then below that, we have the S&P 500 daily chart. That's in blue and black. Below that, we have the NASDAQ 100 chart, the triple Qs, in the cyan and orange, okay? So why is the relative performance of the S&P 500, or I should say NASDAQ relative to the S&P 500 important? Well, because in market uptrends, you want to see the NASDAQ 100 outperforming the S&P, okay? In a healthy market, the NASDAQ 100 will outperform the S&P 500. In a vulnerable market, right? In a vulnerable market, the NASDAQ 100 will underperform the S&P 500. How is that useful in calling tops and bottoms and reversals? This is a clean-cut example, right? So this was the period between January of 2024, so this year, all the way to the middle of April. Since the end of January, basically all the way into the end of March, this entire period, the NASDAQ 100 was underperforming the S&P 500, even though the market was going higher, the market was going up, the NASDAQ was underperforming. This is a negative divergence. The NASDAQ diverges negatively away from the S&P, and that signals market vulnerability, and it culminates in this correction, this short-lived correction. So if you saw this coming, you saw the S&P 500 beating the NASDAQ, you would know that something is wrong, right? I should get out of the tech market. I should rotate into defensives, staples, utilities, etc. And when I see the early signs of a correction, I should liquidate all of that and just wait for the bottom. And that happened as soon as we had this breakdown candle. As soon as we had this breakdown candle, that was the confirmation. The actual bottom was actually kind of easy to call, right? It was this bearish engulfing candle, right? We opened higher, closed lower. So this is again why candlestick analysis is key. I went over some examples of why candlestick analysis is important. This is another one. This is a bearish engulfing candle. It is called a bearish engulfing candle because it engulfs, it eats the prior candle entirely. So it opens higher, closes lower. These huge bearish engulfing candles, when they happen for the first time, usually the market will retrace back to the middle of the candle. And we had that, right? We had that perfectly, right? Bearish engulfing, counter rally, failed to move higher, failed to move higher, moved lower again, failed to move higher. So several failures, very, obvious clue to get out of the market, right? It did not happen overnight. The ratio chart told us that something bad was going to happen. The bearish engulfing candle was the first sign that yes, it is going to happen very soon, get out soon. And this second bearish engulfing was the confirmation. So that's kind of a summary of why I use this chart, and what does this chart actually tell us right now? What does it tell us? Well, let's look at it, okay? Let's look at it and see what it's telling us, okay? So we had a very clean uptrend in this ratio chart. Every time we pull back to the 20-day moving average, this dark red line, the NASDAQ bottomed, boom, NASDAQ bottomed, boom, we moved higher, okay? Then this happened, okay? We closed below the 20-day moving average here. We closed below it again and again, 3 times. That was the confirmation. You need to get out here. Okay, that was the confirmation to get the heck out of the market. Something bad was going to happen. And then we got the beginning of the correction. The market actually, the S&P, topped 1 day later. Okay. So that was the first major warning sign. Since then, we've been trading below the 20-day and 10-day moving averages, never closing above the 10-day moving average until last Friday. So this is a clear signal that yes, a reversal is now taking place. The market has bottomed. Dips from this point forward. If we get a dip in the ratio chart, if we get a dip in the S&P, in the NASDAQ, that dip will very likely get bought. We will likely form a higher low, and we will continue to make higher lows and higher highs. So this is a very clean-cut trend indicator that is telling us the trend is changing from down to up, okay? And that's based on the fact that we closed below the 20-day moving average, and we've been trading below it since, even below the 10-day moving average. So that's the first clue. We closed above the 10-day on Friday, okay? The second clue is one of my absolute favorite signals, and it's this. If you take a look at the S&P 500 and the NASDAQ, they both formed this lower low on Monday, Black Monday. Even though that happened, the ratio chart also formed a lower low. But even though that happened, what did happen? What happened with the RSI? The RSI formed this higher low, right? So very clean, bullish divergence. You can see it right here. Let's use the vertical line tool. This was the first low. This is the lower low on the RSI. We had this low, and then we had a higher low. That told us that yes, the trend is now reversing. The close above the 10-day confirms that, right? So we're getting more and more bullish signals now, more and more signals confirming the bottom is in and a reversal is taking place. That again, dips coming up will be opportunities to buy, not to short. They will be bear traps. I hope that makes sense. Now let's move on to the Dow theory model. The Dow theory model tells us that if the Dow industrials, which are up top, diverge away from the Dow Jones transports down below, that means trouble is ahead. And we do have this massive, horrible, nasty divergence. Here it is, consecutive higher highs on the Dow Jones industrials, and the Dow transports have not yet, throughout this multi-month bull run, multi-month rally, the transports have not as of yet formed a higher high versus the high from July of 2023. It's that bad. Okay, so there's a nasty, very huge bearish divergence. Usually divergences that form over multiple months indicate a much larger big picture reversal, a change from an uptrend to a downtrend. And my belief is that this huge bearish divergence will end up resolving to the downside next year. Once the recession hits, I do believe that the transports will continue to look very vulnerable and the industrials will continue to make higher highs, but the transports will not. And that will very likely tell us that yes, recession is right around the corner and a big bear market in 2025 is likely ahead. That's kind of how I read this. So again, big picture stuff, near term, medium term, over the next several weeks, we're expecting a multi-week rally now as we exit this correction, right? As we exit this correction. And after that, we expect either a slightly higher high, right? Or a slightly lower high. And then we move back down in September and in October in accordance with a bearish election year seasonality in October and in September. Here it is. And then we put in the final bottom for the year sometime in September, October, and then we rally for a couple of months, November, December, and that's it. That would very likely be the end of this bull market that began back here in October of 2022, a bottom that we called to the exact date, Wednesday, 12th October of 2022, published a video saying the market will bottom the next day. It bottomed, and we've been making higher highs, higher lows since. Okay, so that's again big picture stuff. Now let's move over to the ratio chart between the XLY ETF, consumer S&P 500, consumer discretionary relative to consumer staples. We do have this nasty bearish divergence, another nasty bearish divergence, indicating that the consumer in the United States is weakening, and very likely ahead we will continue to form lower highs and lower lows even in December and even in the holiday Christmas rally. That is still my expectation. So rally for the S&P, NASDAQ, etc. But this ratio chart between consumer discretionary, consumer staples will likely continue to form lower and lower highs. That means stocks like Amazon, Tesla, etc. will likely show vulnerability after the market bottoms in December and in November. Will likely form either equal highs, lower highs, will underperform the market generally speaking. So very nasty bearish divergence, just like the Dow theory model, indicating that yes, big picture stuff, looking forward several months from today, very likely the economy is in fact tipping into recession, but it will take several more months before that happens. The market will continue to remain in denial for several months before that happens. There's a well-known saying that the market can remain irrational longer than you can remain solvent. That's why it makes no sense to short the market here, even if you expect a recession next year. Okay, let's see. So we covered XLY divided by XLP. Very nasty looking chart. Again, big picture stuff, very negative. Several months from now. Okay, so this is the S&P 500 weekly chart. This is a big picture stuff. Again, look at this. Very clean channel. We broke through it only once through the pandemic. We held the support level of this channel. Every other time, the only exception was the pandemic. And so if we say, okay, maybe we get a recession next year, likely, let's say likely we get a recession next year, what does that look like? Well, to me, it will probably look like something like this. Okay? Boom. So counter rally now, equal lower, lower, low, September, October, another rally, either an equal high or a higher high. And then a multi-month sell-off next year, going all the way back to the bottom of the channel. Okay, so maybe something that looks like, I don't know, 23, yeah, possibly 20 plus 25, 30% down in reaction to recession, maybe lower, but that's base case. So why did I pull up this chart? Well, I want to show you another market structure, right? This is why market structures matter, okay? So we have this huge cup. Then we have the handle. So this is now a cup and handle formation. And usually the cup and handle formation will break to the upside. And the full measured move for this kind of structure is the distance between the top, the neck of the cup. Here it is, the neck of the cup, all the way to the bottom of the cup, right? So that's why I have this vertical blue line. Then what you do is then you take that distance. You take that distance and you put it back up here to the breakout level of the handle. So this is the cup. Boom. This is the cup, handle. Breakout happened here. We put that level right here. And that gives us the full measured move, the final topping target for this entire structure. In fact, I posted this, by the way, everybody, in the Discord community months and months and months ago. Okay, so it's nothing new. Okay, so that final target is, let's see, S&P 500, 5,700. So we're basically at that target. So realistically speaking, the objective upside target has already been met. That means it is very possible that whatever rally we get in September and in October, November, December, after the market bottoms, it could very well be a double top, or could it just be a slightly higher high? That's possible. Now, there's another way that I measured this cup and handle formation to give us the absolute maximum. What is the absolute max possible objective measurement? It's the same stuff, but instead of measuring from the breakout level of the cup, of the handle, you go all the way to the neck of the cup and handle formation. This is the neck, and you measure from that distance. That gives us this objective target, this red target, and this target is at, let's see, 6,050. So What does that tell us? Well, it tells us that the market will very likely top this year between 5,700 and 6,050. Somewhere in here will be the final top for this massive bull cycle that began in late 2022. Okay. Take a screenshot of this if you need it, or annotate these levels on your chart if you're interested. Okay, high yield bonds up top, S&P 500 down below. This is the smart money up top. This is the S&P 500, or quote unquote dumb money down below. I use this chart to look for divergences. There is a bullish divergence between these two charts. Here it is. The smart money has already exceeded these prior highs, right? Here it is. That's the same level. The S&P 500 hasn't done that yet. That tells me, that this is bullish and very likely will move all the way back to these prior highs. That means the S&P 500 very likely moves back all the way to 550 plus. So 552, 553, somewhere in here to this prior level of resistance. Okay. So let's go back. Something that looks like this. At the end of August, that's my target. And then we move back down. I hope that makes sense. Okay, so that's smart money covered. Okay, let's take a look at another chart. This is the smart money risk appetite indicator. Usually when we go from red to green on the PPO, it is usually bullish, especially if we cross below the zero line. That means this is a buy signal. Here it is. Let's put it on vertical line. Boom. This is a buy signal because we crossed below the zero line. We recovered, printed a green bar on the PPO histogram. That was a buy signal. The market rallies from there. Okay. Now, sell signals aren't as good in a bull market. For example, we had a sell signal here. The market continued to move higher. We had a sell signal here. We did get a moderate correction. Sell signal here, not much happened, right? So the sell signals in a bull market, not great. The buy signals are great. And we are about to form a buy signal soon-ish, probably next week. Dollar index, DXY up top, dollar index up top, S&P 500 down below. These are generally speaking inversely correlated. When the dollar moves down, the S&P moves up. Generally speaking, that's the case. The correlation is not as tight as it used to be, excuse me, when the Fed was hiking rates. As soon as the Fed starts to cut rates, the dollar will move down and break below these prior levels of support. And as soon as that happens, that means bonds will go up, gold will move up, and likely defensive assets in the S&P 500 will move higher. This is a big picture development that hasn't yet taken place, but it is likely happening by September. US 10-year yield, amazing. This level of support held. It was support here, held again here. This level will eventually break with the 10-year yield, and it will mean that TLT long-term treasuries, which I have layered down here, will start to move beyond the 2024 January highs and start to really rip higher. And that will likely happen when the Fed starts to cut rates in September. SPY relative to gold, S&P 500 relative to gold, that's up top. Down below is the S&P 500. Another risk barometer that I look at, risk appetite indicator that I've used consistently. We get a buy signal when the PPO crosses below the zero line and then prints a green histogram signal and crosses over. That is usually a buy signal. We did have one very short-term buy signal here. Boom. And it got reversed just several days later here. So if you bought on the buy signal and sold on the sell signal, you will have broken even, right? So this is a wash. However, big picture stuff, when we get a cross up from oversold, extremely oversold conditions on this ratio chart, it is usually bullish. And gold has been outperforming the S&P. S&P 500 ETF has been underperforming gold. That's why you see the ratio chart dropping. However, we'll probably get another crossover, just like this risk barometer chart that I use. This is for the bond market, and this is for gold and the S&P, and that will likely also trigger a buy signal soon enough. Okay, soon enough. This is the CPC put to call ratio signal, and this is the PC put to call ratio signal. We have crossed all the way to the top. I haven't covered this signal in ages because we haven't gotten a major signal in ages. We've moved all the way to that. By the way, everybody, you will not find this signal anywhere. I'm the only one I'm aware of that uses this put to call ratio in this specific setup. Okay, it's a specific setup. This is the 5-day moving average. These signals are these levels, I should say, 1.1, at the bottom 0.74, and at the middle 0.95. These are specific to me. I haven't seen anybody use these. The reason I use this signal in this way, in this very specific way, it's because I've back tested it and I found that this is the most accurate combination of settings to use. It's very complicated to set this signal up, this indicator up. I've actually made a YouTube video. I posted it in the Discord community on how to set this exact indicator up, because it's kind of fiddly and complicated. So check that video up. Check that video out in the Discord community. If you're interested, you'll find it in the section called Learning Resources. Okay, so what does this signal tell us? Well, we crossed all the way back up above 1.1. This tells me that as soon as we cross back down, and the PPO crosses back down, that will trigger a major buy signal. Here's an example. Boom, crossed above it, went back down below 1.1. PPO crossed down, confirmed the buy signal. The market bottomed 1 week later. So, big picture stuff, put to call ratio, extremely overshot. Way too much fear and anxiety in the markets after Black Monday. This will get priced out. The put to call ratio will move back down, and the S&P 500 will move back up, very likely to this neckline at 550 to 553 by the end of August, and we'll reassess from that point on. So that's the put to call ratio. Let's talk about S&P 500 breadth. This is the S&P 500 50-day breadth, meaning this chart up above tracks the percent of stocks in the S&P 500 index that are trading above their 50-day moving average. And this has been moving higher, steadily higher, consecutively every day since Monday. And even though we had this weak signal Friday, the breadth improved much. I should say the breadth improved way more than the market led us to believe. With that being said, when we get that spike down, if we get that spike down, I will be looking for breadth to either form an equal low or a higher low. That will be another bullish development, to another bullish check mark to check. Okay, this is the 200-day breadth. So this is I would say a more significant breadth indicator. The 200-day breadth is a more significant breadth indicator versus the 50-day breadth. And the 200-day breadth actually closed lower. Friday closed lower than Thursday. This tells me that we will likely get that dip as expected. That dip will be bought. Hopefully, breadth will form a higher low. That will be bullish. This is the imminent doom indicator. It is long-term treasuries relative to the S&P 500. When we ever close above the 10-month moving average, it triggers really bad stuff. Bad stuff. Okay? And when this closure above the 10-month moving average happens after the yield curve has exited inversion, has uninverted, it usually calls the market top and we get the recession crash. As of right now, this hasn't happened yet. The yield curve is still inverted. We're getting very close to the inversion ending and yield curve normalization. I'll cover that in a second. And the 10-month moving average is this orange line. We moved above it briefly, but we did not close above it. Whenever we close above it, that will be the signal, the time for long-term investors to get out of the market and for traders to start to look for bearish positions, to start to look for shorting opportunities. Another indicator is XLP divided by SPY, so consumer staples relative to the S&P 500. Whenever we close above the 50-week moving average, bad things happen. We did not do that. We got close to doing that this week. We did not do that. My expectation is that will likely happen at the end of the year when the market finally puts in the top. So again, if you're a long-term investor, if you're looking for that clear-cut signal to get out of the market, track XLP divided by SPY on the weekly chart at the 50-day moving average, 50-week moving average. As soon as we close above it on the weekly chart, that will be your signal to get out. Let me actually add a vertical line here to show you what happens. Oh my gosh, look at that. It called the top perfectly. That's insane. It called the top oh my gosh. Okay. I'm giving you way too good of information, guys. Okay. And you will want to look at the TLT relative to the SPY. Whenever we close above the 10-month moving average, look at the monthly chart. Whenever we close above the 10-month moving average, that will be your clue to get out. And what do you know? Boom, we closed above it here. It called the top perfectly. The third chart the third weapon to put in your arsenal is the yield curve inversion. Here it is. This is the 10-year yield divided by the 2-year yield. This is the weekly chart, okay? Up top is the yield curve. This horizontal red line represents yield curve inversion. So when we are below it, the yield curve is inverted. When we cross back above it, the yield curve inversion ends. What do we look for a top? A major market top, a top before a recession. You want to see the yield curve normalize first. That means it crosses back up. Then you want to see XLP by SPY close above the 50-week moving average. Then you want to see TLT divided by SPY, the imminent doom indicator, closing above the 10-month moving average. When you get boom, 1, 2, 3, these 3 signals, you get the heck out of the market. Are we there yet? No, we're getting closer. Not there yet. Several months before that happens in all likelihood. Okay, we're done here with regards to the trading view charts. I'm going to jump to some other charts here very quickly. This is the bullish percent index for the S&P 500. I use this chart to track bullish divergences. We have one here. So the bullish percent index formed a lower low, but the RSI for the BPSPX, the bullish percent index, formed a higher low. How is this useful? Well, it calls the bottoms. Here's another example. Lower low, boom, higher low, called the bottom. Okay, so very useful. Bullish divergence in play now. It is indicating that the market is bottoming. Another thing that I want to really point out is institutional investors bought the dip, retail traders sold aggressively. This again, this goes to show that our smart money indicator is actually smart, right? This is the smart money indicator up top, already cleared these prior highs. Smart money is buying. Smart money is buying. You don't want to short when the smart money is buying. Okay, so smart money is buying, very likely already bottomed, second dip, equal low, higher low to be bought, and we move higher from there. That's really it. I have some other stuff that I want to cover in terms of market valuation, but I think the stream has gone pretty long as is, so I'll probably cover this in a later stream or video. So before we end this, please everybody, if you're not subscribed already, hit the subscribe button because you don't want to miss these streams. And like the video if you enjoyed it. If you watched so far and you did not enjoy the video, I do thank you for your time and attention. And now I'll turn to your questions to cover the tickers that you want me to take a look at here very quickly before we end here. Let's start with TLT, long-term US treasuries. So let's scroll all the way back, okay? Let's take a look at the multi-year kind of chart. We had this very clean uptrend, broke down as soon as the Fed started to raise interest rates. We moved all the way down to these multi-year lows. So this was a multi-year bottom. I, in fact, traded TLT at $92. I bought leaps. I traded TLT all the way to 99, 100. I sold. I think I doubled that trading account in late 2023, and I exited at then. Since then, I've just been waiting for the Fed to cut rates, and the Fed is now going to cut rates, confirmed so in September. It has now been confirmed, basically. And from here, we have this kind of makeshift inverse head and shoulders structure, and it indicates to me that the final low has already been made in late October 2023. We've since been making higher lows, and we are very likely this year to exceed 100 as we continue to make higher lows and higher highs. My upside target for TLT by the end of next year is the full measured move for this double bottom, and it's 130 by the end of next year. That is kind of my upside target for the end of next year. And we're already kind of breaking above this little makeshift channel. Usually when that happens, you double the channel and the market usually goes all the way to the top of this channel. That will likely happen at the end of this year. So very likely back to these highs, 110, 109, 110 by the end of this year as the Fed starts to cut rate. So I am bullish TLT. Let's move on to Nvidia. Somebody asked me about Nvidia. So this is a chart for Nvidia. It had this double top structure. I covered this in the live stream that I posted last week. We had this double top, second lower high. The neckline here, full measured move, is equal to the distance between the neckline and the double top. Gave us a full measured move down to 98.55. I extended the support or the target down lower to, let's see, boom, here, 95 exactly, because that's the gap fill target. We filled the gap. We had this huge rally since then. Very likely second higher low, and we'll move higher from here. So I'm bullish in Nvidia, even though I do believe that the road ahead is tumultuous for semiconductors in general. Semiconductors tend to top before the rest of the market, likely. So I shouldn't say likely, but now it's a big question whether Nvidia and the rest of the semiconductor index will form a higher high or an equal high, and that will be it. I do believe that likely, I would say I'm leaning toward semiconductors forming a higher high. That's because I'm seeing stocks, or I should say companies like AMD raising guidance, so that's positive. And we'll glean some more information from Nvidia at the end of August. And so for now, I expect something that looks kind of like this. So a slight higher, potentially slight higher high, early next week, and then we move back down to form that second dip, or maybe we just move back down to form that second dip and then move higher. Either case is fine. I am, full disclosure, long Nvidia. I bought leaps at the open right here, somewhere in here, I think at 100.7, $100.70. I bought leaps on Nvidia. I'm still holding these leaps. I traded around them. I took down my average cost Friday. I took profit at the open, then I entered again after the pullback. I'm still holding these leaps, and I'll probably continue to hold until the end of August. By the way, if you're interested in following specifically what I trade and all the setups that I'm interested in, please just Google Money Time Machine Patreon. There it is, and you'll be able to sign up for the membership. So that's for Nvidia. Let's take a look at AMD. This is AMD. We had this kind of double bottom here. There's no bullish divergence. There's nothing that big except this key support line, this key trend line, and again held here, held again here, held again here. So this is the bottom of the channel, this long-term multi-year channel for AMD, and then we had this double not double bottom, I should say, a double tagged here, tagged again, this bull flag that is forming, right? And I do expect this bull flag to eventually break out sometime after the election. So November, December, a rally all the way. My expectation is actually all the way to $300 by early next year, the end of this year. I'm actually more bullish AMD than I am Nvidia and the rest of the SMH index. That's because if we take a look at the AMD SMH relative chart, it is at a major level of support and it formed this double bottom. And if we simply rally to the top of the range, that means AMD will exceed the semiconductor index by 75%. That means AMD will outperform SMH by 75%. So that's AMD, Nvidia, TLT. Let's go. Let's cover Tesla. So this is Tesla. We had this major level of resistance, or I should say trend line, this resistance trend line, rejected once, twice, 3 times, 4 times, and then we broke through it. We went back down, kind of holding the 80-day moving average, the 50-week, no, not the 50-week, excuse me, the 20-week moving average, this dark green moving average, this is the 20-week moving average, the 80-day moving average. We've been consolidating around it. We had this breakout, backtest of this prior level of consolidation. Tesla has likely bottomed and it will likely rally back up and it will likely break this resistance line again. My target for Tesla is right around that for AMD, which is around $300 by the end of the year. So I am bullish Tesla. However, I don't hold any leaps in Tesla because the options are just a little bit too expensive for my taste. So that's Tesla. SMH, let's do SMH. You've been asking me about SMH. So this is SMH. This is the pitch fan. It's kind of the trend line for the semiconductor index, connecting key bottoms and connecting key tops. We're not yet at the top of this pitch fan. That tells me that potentially, possibly, semiconductors will continue to rally and make a higher high. That's why I'm bullish AMD and even Nvidia. Even though they've rallied so much, it's because we're still not at the top of this resistance line. Likely we'll get there, excuse me, by the end of the year, early next year. That's why I have that $300 target on AMD, and that's why I'm still bullish semis. That's why I'm actually still long Nvidia. So that's for the semiconductors. Pulled back to the 200-day moving average. They still have more upside to go. New highs likely. I'm leaning toward new highs rather than a lower high or an equal high by the end of the year. So something that probably looks like this. End of August, back to 255. We move back down in October and September. Then we rally back up all the way to the top of the channel, all the way to the top. That's huge upside, 60% plus upside. If we don't get any nasty surprises after the election. That's SMH. What else did I forget? I think somebody asked. Yes, Coinbase. I did not forget about Coinbase. Let's do Coinbase. So this is Coinbase. We're still trading within this channel, or I should say, not a channel. It's a bull flag. This is the channel. Right? We broke above it briefly, came back inside the channel. Key level of support is 190. We actually held 190. We briefly broke through the bull flag support. Not a big deal at all, as long as we continue to find support at the bottom of the channel. This long-term channel. I'm also bullish Coinbase and Bitcoin. I am still long Bitcoin, holding IBIT still. And my expectation is that Bitcoin will double by the end of the year, all the way to $120,000. And for Coinbase to rally all the way to the top of the second channel, because typically when we get the breakout above the channel resistance, we double that and we go all the way to the top of the second channel. That means Coinbase somewhere around $1,000, if you can believe it, by the end of the year or early next year. That's massive upside, also massive risk. So please take that with a grain of salt. I'm not long Coinbase. I'm long Bitcoin. I will probably open a long position in Coinbase later in September, potentially in October. Not just yet. I want to see first a breakout above this flag resistance. Once that happens, I will probably go long Coinbase, but I'm not long as of yet. Amazon, pretty nasty breakdown, unfortunately, after earnings. However, I do expect this gap to get filled. So a rally by the end of August to at least fill this gap, probably exceed it all the way to this key resistance level. Resistance once, twice, broke through it, came back, resistance again, major level of resistance at 190. So likely by the end of August, we go back to 190. I am bullish Amazon, but not as much as I am bullish other names. And we did briefly break below this channel, which is unfortunate. Not a big deal yet, but it is quite unfortunate. Okay. Wheat. Somebody asked about wheat. Let's do wheat. Because why not? I covered wheat in the Discord community several times. We're now at multi-year lows. Multi-year lows. I am bullish wheat. RSI is improving. Notice the huge bullish divergence on the RSI. Look at this. Right. Low, higher low on the RSI, low, lower low on the weekly chart. My favorite bottoming structure, double bottom with a bullish divergence at a multi-year demand zone. I am bullish wheat, and my target for wheat, especially as the Fed starts to cut rates, because as you all know, when the Fed starts to cut rates, it weakens the dollar. When the dollar is weakening, commodities like to rally. My target for wheat is right here. So 7.3 is my target for wheat, the wheat ETF. What other tickers you've been asking me about? Baidu, okay, and Baba. Let's do Alibaba. So this is the daily chart for Baba. It is bullish. We have consecutive higher lows. Let me pull here. It is consecutive higher lows. We have this neckline. Was resistance several times, then we broke through it, came back through it. It is now support again. And my expectation for Baba is a rally all the way to $125, probably sometime next year. Not this year, probably sometime next year, potentially early next year. As the Chinese economy improves in the near term, we are still making higher lows and higher highs. So in the medium term, this would be my upside target back to these prior highs at $100. Let's actually draw a channel here, something that looks like this. So we're still very early days. We're not trading above the 200-day, the 50-day, the 80-day, the 5-day, the 10-day, all the moving averages. Bullish in my opinion. We do have earnings coming up, so that's a risk factor to take into account. Overall, I'm still bullish as long as these lows hold. And my target is $100 probably by the end of this year, $125 by next year. Let's do Baidu. I don't think I've covered Baidu in ages. So Baidu, not as bullish as Baba. Still in a downtrend, still trading below all the moving averages. We do have somewhat of a bullish divergence here, but I'm not a big fan of these bullish divergences in a huge downtrend like this. I need to see more, right? Typically, what I would want to see is a rally that takes out this prior high. Then we move back down, make a lower low, and that divergence is what I would buy, right? I need to see a sign, a signal that the trend is changing. The first signal would be a higher high versus these prior highs. That hasn't happened yet. I don't like Baidu as much. I would actually say I'm bearish Baidu. So I like Baba, not so much Baidu. Okay, guys, I'll be ending the stream soon. I'll cover Apple. Please post in the chat for the final time before we end the stream what other tickers you want me to cover, so we can end the stream. I'll cover Apple, then I'll come back to the chat, see what else I missed, and that will be it for the stream. Okay, let's do Apple. So this was the expected move for the earnings. Let me delete that. By the way, guys, I do a lot of pre-earnings analysis for the Discord community members. If you want to trade stocks in earnings, I do map out the expected moves in my overall take on the stock. Okay, Apple looks pretty darn good. Held at the 20-week moving average, the 80-day moving average. That's positive. We have the first close above the 10-day moving average since that breakdown in late July. All green candles since that bottom on last Monday. So I do expect some kind of continuation higher to around 220, then maybe back down, second dip, higher low, that to be bought, and then higher highs and higher lows from that point on. So I'm bullish Apple. I like Apple. Full disclosure, I'm not long Apple because the options are just too expensive for my taste. So very near term, look for a gap fill at 220, then move back down, right? Higher low, that dip to be bought, move back up, higher high. GameStop, I'm sorry, Ricky, I'm not gonna do GameStop. Okay, I'll do GameStop. You changed my mind. I'll do GameStop. We don't like meme stocks here, but I'll do GameStop for you. Okay. And I did in fact trade GameStop here. I bought it here for the rally to 40, and I sold. I covered this actually for the trading community. When DFV, Deep Effing Value, posted that tweet, I said this looks like a very typical penny stock setup. I used to trade penny stocks a lot before 2019, and this looked like a classical penny stock setup here, right? Move all the way back down to the 10-day moving average, start to make higher lows, went back to $40. I had $40 as the target. It actually exceeded that, went up to 48. But my target was kind of a gap fill. It filled the gap, and that was it. I'm not bullish GameStop. I don't think it's a good stock to buy or to trade because the options are way too expensive, way too much manipulation, and it's overvalued. Right now, I am absolutely bearish GameStop. This now looks like a typical spike and cup formation, and usually it means we move all the way back down, boom, to the prior neckline. That means $15 or lower for GameStop. So unfortunately, just like Amazon, Microsoft was trading inside of this channel. It broke the support of the channel, just like Amazon. It's the negative sign. I don't like that. Unfortunately, stocks like Nvidia, Semiconductors, AMD did not do that. They did not break through. Big cap tech did. Fortunately, I don't like that. However, I do expect, just like the NASDAQ 100 and the rest of the tech sector, Microsoft will rally. My target for Microsoft by the end of August will be boom, smack here, 430. Why? Well, very clear level of resistance. Resistance once, twice, boom, 3 times. It actually several times here, not once, twice, several times. So something that looks like this, very likely. Okay, so bullish Microsoft, but it is starting to look vulnerable like Amazon and the rest of these stocks. Upside target to 430 by the end of August is my upside target for Microsoft. So something maybe looks like, right? Backtest of this prior support line, now resistance. That would actually make perfect sense. Perfect sense. End of August, go to 430, tag resistance line, come back down. Perfect sense. I like Bitcoin. I'm bullish Bitcoin. I bought it here. As soon as it tagged the support line, I bought the IBIT ETF. It is starting to look kind of, consolidating. Probably second dip will be bought just like the rest of the market. I'll be super bullish Bitcoin once it breaks above this bull flag. This is a huge bull flag, and just like prior major cycles of Bitcoin, when we break above a key channel resistance, just like here, boom, we break through it. We usually rally all the way to the top of the channel, come back down, tag the support, break out again, and then move on to make new highs. Kind of still my expectation for Bitcoin. It is looking more vulnerable, but it's still holding this bull flag. So that's still kind of my expectation. Should be bought at the bottom of this bull flag. As soon as it tags it, should be bought. And confirmation is when it breaks, boom, it breaks this bull flag resistance. At that point, it will generate an upside target of $120,000 by the end of the year. That is still my target, believe it or not. So last call, everybody, last call. Post your ticker that you want me to cover. Last call before we end the stream. I'll answer these questions. We have a couple of questions here I'll answer very quickly. AJ asks, can you tell us the 3 best stocks to buy every month if we join the YouTube membership? The answer is I do that in the Discord community. Not necessarily the best 3 stocks every month. I don't have necessarily the top 3 or something like that, but I do point out my favorite setups. Not just every month, pretty much every week I post the setups that I like the most, and all of my trades, when I make them, I post immediately in the Discord community, alerts whenever I do that. And I also do technical analysis on request in the Discord community. If you're interested in a specific ticker, you just post it in the Q&A section in the community, and I answer that question. I cover that ticker for you. Somebody asked about Meta. Let's do Meta. Why not? Let's do Meta. So Meta. Tag the 200-day moving average. Very close, not quite, but very close. Outperformed the rest of tech quite decisively. Okay, quite decisive. I was actually kind of bearish Meta into earnings because it did not decline as much as these other big cap tech names like Amazon, like Microsoft, etc. But objectively speaking, look at this channel, this uptrending channel. We broke down as soon as we entered that bear market in early 2022. As soon as we enter back inside the channel, Meta likely does not top until it reaches the top of the channel. That means a rally all the way to about $700 by the end of the year. That's still my expectation for Meta. In the medium term, it is now forming this kind of range. I would call it a range. So medium term, kind of a mixed bag here for Meta, but coming out of November, not November, coming out of October, September, I would say I am bullish Meta for a rally back to 700. In the medium term, expect rallies to the top of the channel, then pull back to the bottom of the channel. As long as we trade inside the channel, that will be the case. That only changes once we break above the channel resistance, then we move higher. So kind of medium term outlook is this, right? Kind of something that looks like this by the end of August. Move back down October, then move back up November, September, November, December, all the way to 700 by the end. That's kind of outlook for Meta. Tom Lee, crazy bullish, sees 50% upside. 50% upside on what exactly? What are you referring to? Are you referring to the S&P? And that, in which case, definitely not 50%. Absolutely not. I already covered the upside target for the S&P 500, and the topping target is between 570 and 600 this year. It's based on the full measured move of this cup and handle formation. I already covered this in the stream, by the way. Go back and watch. If you missed it, it's this range. It depends on where you measure from, whether you measure from the breakout level, in which case the target is already met. You measure from the neck of the cup, that means rally to 6,000 for the SPX, 600 for the SPY ETF. Oh, Palantir. I haven't covered Palantir yet, so let's do that now. My upside target for Palantir is $40. Okay, it's trading inside of this upside channel. It's a buy whenever it tags the support level of the channel. Kind of happened here. Tag the 200-day moving average, bounce back up. I am bullish Palantir. Okay, that's it, folks. Thank you so much for watching. Smash the like button. Thank you so much for watching. If you enjoyed the video, remember to like, subscribe if you haven't yet. Check out the Patreon community to join the Discord trading community, where I share my daily technical analysis, weekly expected moves for a bunch of stocks and ETFs, and where I share my trade setups and all of my trades basically go in the trading community. So check that out, Money Time Machine on Patreon if you're interested. And I also post in the Discord community whenever I go live. So if you're part of Discord, you will immediately get notified. Oh, I actually forgot about CrowdStrike. Sorry, Cole. I'll cover that right now before we end. Thank you for reminding me. Let's do CrowdStrike. Broke through the support line, kind of like Amazon and Microsoft, right? Held throughout the bull market, broke through it. This tells me huge change in trend coming. I'm absolutely bearish CrowdStrike. I would not short it because the put options way too expensive. This is kind of what I expect for CrowdStrike. Backtest of this prior trend line, reject somewhere at the snack line. So 280 max, 275, something like that, reject and move back down. That's it, legends. Thank you so much for watching. Thank you so much for sticking through this pretty freaking long stream. Again, everybody, smash that like button, and I'll catch you in the next one. Bye-bye, everybody.